Welcome again, dear students and scholars. We continue ASC 260 with Basic EPS Special Adjustments. Videos 2 and 3 gave us the foundation, the numerator and the denominator. Now we handle the tricky situations where the formula stays the same but the inputs need extra care. This lesson is about knowing exactly which side of the formula changes because most basic EPS traps are not caused by difficult math. They are caused by placing the adjustment in the wrong place. Here is the path for today. We will look at preferred dividends paid in common shares, down round features, contingently issuable shares, post period stock splits, and then a short trap practice. As we move through these topics, keep one question active in your mind. Does this item change income available to common shareholders, weighted average shares, or only presentation? That question is the control panel for this entire lesson. Before calculating, map the adjustment. Some items reduce the numerator, such as preferred dividend claims, triggered down round effects, and certain written call option modification effects. Some items affect the denominator, such as contingently issuable shares once the condition is satisfied, or stock splits applied retroactively. Do not guess based on the instrument name. First classify the issue, then calculate. EPS rewards mapping before math. There is no new basic EPS formula in this lesson. Basic EPS is still adjusted common income divided by adjusted weighted shares. What changes is the precision of the inputs. The numerator may need deductions beyond the standard preferred dividend case. The denominator may need contingent shares or retroactive split adjustments. Think of the formula as the same machine, but today we are cleaning the inputs before putting them inside. Preferred dividends paid in common shares are a classic trap. The rule is simple. A preferred dividend reduces income available to common shareholders even if it is paid or payable in common shares instead of cash. The payment form does not erase the preferred shareholder claim. Preferred shareholders are still receiving value ahead of common shareholders, so the numerator must still be reduced. Here is the mistake many students make. They see that no cash was paid and assume there is no numerator effect. That is wrong. EPS is not asking whether cash left the company. It is asking how much income remains for common shareholders after preferred claims. If preferred shareholders receive their dividend in common shares, the claim still exists. The right answer is to deduct the preferred dividend from the numerator. In this example, net income is $420,000 and the preferred dividend is $24,000 paid in common shares. The numerator is not $420,000. We deduct the preferred dividend and arrive at $396,000 of income available to common shareholders. If the dividend had been paid in cash, the numerator would be the same. The form of settlement does not change the deduction. Now we move to down round features. A down round feature usually protects the holder of a convertible instrument or warrant by lowering the conversion or exercise price if the issuer later sells equity at a lower price. When an equity classified down round feature is triggered, the value effect of that trigger reduces income available to common shareholders for basic EPS. This is a numerator adjustment, not a denominator adjustment. The economic logic is important. When the down round trigger reduces the conversion or exercise price, the holder receives additional value. That value effectively comes at the expense of common shareholders. ASC 260 reflects this by reducing the numerator. The deduction is not the full fair value of the instrument. It is the increase in fair value caused by the trigger. In most exams, that value effect will be given to you. Now look at the example facts. Net income is $600,000. The down round effect is $12,000. Weighted average shares are 150,000. The exam skill is not building a valuation model. The skill is knowing where the $12,000 goes. It reduces income available to common shareholders before we divide by the weighted average shares. The calculation is clear. Start with net income of $600,000, deduct the down round effect of $12,000, adjusted income available to common shareholders becomes $588,000. Divide that by 150,000 weighted shares, and basic EPS is $3.92. If you ignored the trigger, you would get $4, which overstates basic EPS. Contingently issuable shares require a gate test. For basic EPS, these shares enter the denominator only when all required conditions have been satisfied and there is no remaining circumstance under which the shares would not be issued. Until that gate opens, the shares stay out of basic EPS entirely. Do not use the diluted EPS contingency test here. This is basic EPS, so the condition must actually be satisfied. Contingently issuable shares can appear in different forms. They may be shares that will be issued only after a future target is met. They may be shares held in escrow. They may even be shares already issued but returnable if a condition fails. The legal form can vary, but the question remains the same. Has the condition been fully satisfied with no remaining obstacle? If not, exclude the shares from basic EPS. In this example, 24,000 contingent shares are excluded at the start of the year because the condition is not yet met. On May 1st, the gate opens. From that date, the shares enter the denominator and are time weighted. May through December gives 8 months, so 24,000 multiplied by 8 over 12 equals 16,000 weighted shares. The key is not January 1st. The key is the condition satisfied date. Now consider a stock split after year end but before the financial statements are issued or made available for issuance. This is a narrow but important rule. If the split occurs before financial statement release, the EPS denominator is adjusted retroactively for all periods presented. Do not time weight the split from the post-period split date. The split changes the share unit, so comparability requires retroactive adjustment. Certain written call option modifications can also affect basic EPS. If an issuer modifies or exchanges a freestanding equity classified written call option, such as certain warrants, and the modification transfers additional value to the holder, the effect may reduce income available to common shareholders. Keep the level practical. You are usually not asked to compute the fair value change from scratch. The tested point is that this is generally a numerator effect, not a denominator effect. Here is the trap board. Share paid preferred dividends are still deducted from the numerator. Triggered down round effects reduce the numerator. Contingent shares are not added until the condition is satisfied. Post-period stock splits before financial statement release are applied retroactively, not time-weighted. These traps look different, but the exam skill is the same. Place the adjustment on the correct side of the formula. Now take a moment to classify the three facts. Fact A is a preferred dividend declared and payable in common shares. Fact B is a contingent share agreement where the threshold has not been met. Fact C is a triggered down round feature with a fair value effect of $15,000. Before you check the answer, decide whether each item affects the numerator, affects the denominator, or is excluded from the current basic EPS calculation. The answer follows the adjustment map. Fact A affects the numerator because the preferred dividend is deducted even though it will be settled in common shares. Fact B is excluded because the earnings threshold has not been met, so the contingent shares do not enter the basic EPS denominator. Fact C affects the numerator because the triggered down round feature reduces income available to common shareholders by $15,000. That completes basic EPS. We have now covered the numerator, the denominator, and the special adjustments that create common exam traps. In the next video, we begin diluted EPS with the treasury stock method for options, warrants, and similar instruments. If this lesson helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building this US GAAP course with clarity and exam value.